want to talk with you about how to optimally design a whole life insurance policy. Now, this conversation is about base premium and paid up additions riders. And if you're not familiar with what that means or why we would even be talking about this, let me bring you back to square one for just a moment, because this conversation is something that trips a lot of people up when they are shopping for whole life insurance, and specifically for whole life insurance that they can use for privatized banking. Now, rewind to square one. Privatized banking is a way for you to be able to put dollars into a place and store that, or have a place to store cash, where then you can grow that cash. It's safe and it's liquid, meaning you can borrow against that cash and put it to work in another asset or another investment that produces cash flow, and then be able to replenish that store of cash inside of your privatized banking system. Now, specially designed whole life insurance has been an ideal tool for accomplishing this purpose because it allows you to grow that cash value with uninterrupted compounding, which is one of the main powerful features of privatized banking. Now, if you are familiar with privatized banking and you know what it means to design a whole life insurance policy already, go ahead and put in the comments below, yes, I know about privatized banking. If you're coming to this video and you have never heard about privatized banking, please put that in the comments below. Say, no, I have never heard about privatized banking. I would love to get a feel for where you're coming from and where you're at right now, so we can really design the most beneficial resources and tools for you in your journey and your current level of education, so that you can get the resources that you want. So now that we've discussed briefly what privatized banking is, the tool of specially designed whole life insurance has a lot of people confused, because here's why. Some people design those policies with one type of premium, and some design policies with more of another type of premium. And what do I mean by that? Well, there's almost this sliding scale or a spectrum if you think about the dollars that you put into a whole life insurance policy. Base premium would be at one side, and paid up additions riders would be at the other. Now, you can design a policy anywhere on that sliding spectrum with all base premium and no paid up additions riders, or almost all the way over to having very minimal base, or I would call it a skinny sliver of base, and almost all paid up additions riders. I've heard of as high as 90% paid up additions, 10% base. So I'll switch that ratio. So I always say the base first, 10% base, 90% PUAs. So anywhere in between that 100% base, 0 PUA, or 10% base, 90 PUA, what's the right ratio? Now, another problem is that you have people going around saying there's only one funding ratio. There's only one way to do this. And if you don't get this exact funding ratio, you're getting misled, or you're getting ripped off, or you're not getting what you really want. The problem is there's a lot more to the story, and there's not only one funding ratio. So how do you need to think about this, especially if you're the user of the privatized banking policy, and maybe you really don't care about all the levers and like looking down into a motor inside of a car, you just really want the car to run, or maybe you don't want to really understand the soundboard and the mechanisms that make the sound happen. You just really want to have this amazing, vibrant ambiance in a room. So like that with your policy, you want a policy that drives well. You want a policy that gives you maximum early cash value, meaning the dollars that you put in today, most of that becomes available to you in the form of cash value in year one. That's what you want. In addition, you also want the maximum long-term growth. And by long-term growth, I mean having your money that you put into the policy grow as much as possible, so that your cash value further down the road, think like 10, 20, 30, 40 years into having this policy, is the most growth that you can get as well, so that you not only have a policy that performs great out the gate, but also wins well and goes across the finish line of your life really well. So in order to get both of those objectives accomplished, early cash value and long-term growth, here's how we want to think about a funding ratio. Base premium is like the base or the foundation of your policy. It's the main policy. Now, as you pay in base premium, it's kind of like paying on your mortgage. Over time, you are paying towards the full house value, and you're building equity slowly over time. That's kind of how you can think about a base premium inside of a policy. Now paid up additions are a little different. Think of using $25,000 cash to put a addition on your house, a garage. I don't know if a garage would cost $25,000, but just let's say that you could do that. Then that garage would be annexed or connected onto your house, onto your base policy. And what is happening is that portion is fully paid up, meaning that garage is fully paid for, and the equity in that garage itself is increasing the overall value of your house, but you also have that portion fully paid for. So paid up additions riders are kind of like that, where the money that you put into the paid up additions rider is available much more quickly for cash value, but it contributes less to the overall death benefit of the policy. So base premium pays more towards death benefit, much less towards early cash value. Paid up additions contribute less towards the death benefit, but much more to early cash value. So on that sliding scale between base and PUAs, where's the perfect ratio? Now, we tend to fall in the 30% base to 70% PUA ratio generally in kind of a philosophy or a theory of how we design policies. However, it matters what particular carrier you're using along with the particular product with that carrier. Now, for instance, we have seen a policy with 50% base, 50% PUAs perform ideally just the same way that another carrier's product might perform if you designed it with 20% base and 80% PUAs. So there's not a one-size-fits-all funding ratio. But here's a few really important things to think about. One is that if you have more base premium and less PUAs, the base is a required premium, where the paid up additions rider is not required. It's more optional. It's optimal to put it in, but at the same time, it's optional, meaning that if you don't put it in, you're still going to have a policy in force. Now, if you have mostly base and less PUA, you have to pay a good chunk or a good majority of that premium. However, if you have less base and more paid up additions, you're in a position where you have more flexibility to pay less of the policy and still keep that in force. That's one thing to think about. Another thing is that the way a policy grows really has everything to do with dividends. And dividends can be a little bit hard to handle and understand because on an illustration, you are looking at the projected performance into the future of a policy that has not yet happened. You haven't walked the trajectory of this actual growth. But on the illustration, you can look at the guaranteed performance, which is going to be credited based on interest, a guaranteed interest rate inside that policy that is going to be fixed. Then you have the dividend portion, which is the non-guaranteed side of the illustration. So imagine I'm looking at one illustration here and another one here. I'm going to see a guaranteed column and a non-guaranteed column. Now, it can be really misleading if we look at the non-guaranteed column of two life insurance illustrations and look out to, say, year 30 and compare those cash value dollar amounts, because how they arrived at that non-guaranteed cash value amount has everything to do with dividends. Now, dividends on the illustration are shown according to today's dividend scale, meaning whatever today's dividend rate is for company A and company B, they're going to use that same dividend and, for instance, and if you will, copy and paste that every single year down to the end of the policy. Now, we know that dividends are not fixed. That's why they're non-guaranteed. These are highly anticipated that they will be paid. These companies that we work with have paid dividends well over 100 years, and we're in a position where we highly anticipate they will be paid in the future. However, the amount of dividend is not a guarantee. So then we have to think about, what do we expect dividends to do in the future? Well, dividends follow the bond market. And right now, interest rates are very low. So the dividend rates in policies is very low. What can we expect in the future? Again, I don't have a crystal ball, but we expect dividends to go up in the future as interest rates rise. So that means that if you look at an illustration today, in 2019, when this video is being published, the dividend rate is fairly low. If we put a policy in force today, and we look at what that illustration is over time and jump down to, say, year 30, maybe by the time we get out to that actual year 30, dividends have risen tremendously, and they might be in a position where the policy has far outperformed what was on the initial illustration. But here's something really important about dividends. They credit more on the base premium rather than the paid up additions rider portion of the premium, which means that over time, if you have one policy that has more base premium and less PUAs, another policy that has less base and more PUAs, your dividend is going to grow more on the policy that had the higher base. Now, what that means is that if we expect dividends to go up in the future, then I want a policy that's going to take advantage of and optimize the dividends inside that policy and have the maximum long-term growth. I don't want to sacrifice the finish line just because I wanted to get early cash value today. So when we look at policy design, there's a lot of factors that really go into this mix. Now, this can sound really complex and really complicated, but the most important thing is really to focus on what is this policy doing for me? Not necessarily what are the levers that are being changed or adjusted to design that policy and what's going into the policy, but what's coming out. What is the actual performance? How can I see what is going to perform best for me over time? And that means you really want a good balance and good mix of base premium and paid up additions riders. So the most important thing to focus on is not only what the illustrated dividends are, but if we end up in a rising dividend rate environment, which policy is going to outperform into the future? And how can we not give up early cash value so that we can start using that policy right away? Now, I hope this video has been beneficial and useful to you. And if so, I would love you to tell us in the comments below. What questions do you have after hearing this video? Because these are questions that we want to help you through so that you can get the information that you need, the education that you need, so you can build the confidence to take action and move forward with the best financial strategies in your life that help you maximize cash flow and control.